My name is Ashley Mataisi. I am the Director of Outreach with 10 Capital. Thank you all so much for joining today's Ask Me Anything session about sourcing investors. We do want this to be as informative and interactive as possible, so we do welcome you to turn on your video and your audio. Feel free to ask questions. If you are not comfortable with that, totally fine. Also, just drop any questions you may have in the chat box, and we will get them answered for you. I'd like to introduce CEO Hall Martin, who will be giving the presentation today. Hall, go ahead and take it away.
Thank you, Ashley.
And slides.
Thank you guys for joining today. Today we want to talk about the different kinds of investors out there and which one might be best for your campaign as well. So with that, let's go and kick off with some slides. Go ahead and put in the chat box any questions and we'll take a break along the way. So my background is I started angel investing over 20 years ago. And back then, there were angels, there were venture capital funds, and there were accelerators. And that was about it. And today there are many more investor types in the early stage funding arena. And so my experience with these groups is that there's more definition out there, there's more segmentation. And so you need to look for the right kind of funding for your deal. So first, what's new is crowdfunders, and typically they invest $500 to $2,500 per person into a deal, and they're expecting 2 to 3x their investment in 5 years. Then there's traditional VCs. They invest $150K to $500,000 on the first check and expect 10x their investment in 7 to 10 years. And then there's pre-revenue VCs. They invest $150K and they expect 3x their investment in 3 to 5 years. And then there's nano VCs. These are people with about a $10 million fund. They invest $100,000 on the first check and expect 5x their investment in 5 years. Micro VCs are those with the $25 to $50 million funds, and they invest $150K on the first check and expect 5x their investment in 5 years. Then there's VCs that have accelerators, or sometimes called venture studios. They invest $150K to $250K on the first check, and they expect 3x their investment in 3 to 5 years. And then there's incubators and accelerators. You can get anywhere from $25K up to $150K, and they expect 3x their investment in 5 to 6 years. And then there's angels. They invest $25 to $50K per person, and they expect 3 to 5x their investment in 5 to 7 years. And finally, there's high net worth individuals. They invest $100,000. They're expecting 10x their investment in 5 years. They have a higher expectation. And one more is the family office. They write 250K checks on the first round, and they expect 5 to 10x their investment in 5 to 10 years. And so what you want to do is match your deal for what funding might come out of it and what the return might be. And so you look at your deal to see what the return is, and then you match to the right investor who might give you the initial money for it and others like them. So today we're going to dive into 4 of the more popular ones: the venture capital, the angels, the family offices, and then the high net worth individuals. These are the core 4 that we see a lot of, that is the mainstay of the community. Crowdfunding is growing, and we do see a lot more accelerators, but still these 4 are the ones that are up most there. So the first one is venture capitalists. And so what you need to realize is a VC is a professional with experience in the startup world, and they're either coming from the financial space or they have run a startup in the past. So they're doing one or the other, maybe both. And they invest funds from limited partners such as family offices and pension funds, and they invest for home runs. They're looking for a 10x return. If you're not a 10x return, they don't care. So what you want to do is go through and see, does your deal fit that model? And if it does, then a VC is a good model for you. So if we go, let's see. So the next one is they look for a standard business model in high growth sectors, again with a very high return. On the next slide, for angels, they're typically successful business people who invest their own money as a side project from their day job. They look for a 3 to 5 times return on their investment. And they have a fair amount of capital preservation in mind. They really don't want to see the business go under. Venture capital expects only 1 out of 10 deals to be a home run. The rest are going to go under, so they don't care. They'll take a high risk, high reward approach. Angels are a little bit less high risk, and of course, there's a little bit less reward there as well. But they often look at businesses in non-high growth sectors. So if you're in a very hot sector like AI or blockchain, well, then VC may be a good fit. If you're not in one of those sectors, then angels are a good fit. And they invest 50 to 100K on the first rounds, and sometimes they set aside funds for the follow-on round. And there's a saying in the angel world that angels want to do a little good, have a little fun, and make a little money. And then, so on the next slide, there are family offices. And these are businesses set up to invest their own funds for a return. And they often have impact investing as part of their investment thesis. So if you have a deal that has a community service or a social cause or a give back in some way, family offices are a good fit. And they also look at businesses like angels in non-high growth sector, but they write substantial checks. They write 250K on first rounds and 500K or more on follow-on rounds. They tend to be patient money. They're not time sensitive like VCs. Venture capital is on a 10-year window, and they have to deploy at least half the fund in the first 3 years, the other half of the fund in the next 3 years, and they're hoping to start getting returns in years 5, 6, and 7. So they're very accelerated in what they're doing. Family offices are not on those windows, and so they can be much more patient in what they're doing. On the next slide, we have high net worth individuals. They're similar to angels, but they operate at a higher level. They're just writing bigger checks for first rounds. 100K to 250K is what they do. And they often have operational expertise as well. Sometimes you can look for your investor to provide just funding, and sometimes you can look for funding plus expertise. And so you want to look for the right one. Traditionally, VCs provide expertise, high net worths provide expertise. You'll find angels are more generalists, and so they'll give you general information, but they don't usually give you sector-specific information. So all of these investors meet the accredited investors criteria. Accredited investors are those the SEC has deemed are as high net worth individuals and can afford the risk that comes along with startup investing. And so if you look at the Securities and Exchange Commission's website, you can see the specific criteria for what that is. In short, it's anyone who has a net worth of $1 million or more, not counting the house they live in. And so which type is right for your deal? So this depends on your type of business and the return and the time frame for that return. So if you're in a high growth sector, you need a large amount of money and you're growing very fast, well, then venture capital is a good choice for you. Not every deal is in that quadrant. And so if you, in what I see more often is you're in a medium growth sector, you need some amount of money, not a huge amount. And you may or may not have a 10x return. You may have a 3x or 5x return, still a good business. And so that's a better fit for an angel investor. If you have a consumer-facing product and you need some amount of capital, then crowdfunding is a good choice. Crowdfunding is the kind of thing where if you put it on a website and somebody goes and looks at it, do they understand what you're doing? And for consumer products, breweries, wineries, and things like that, it does very well because everyone understands what that is and they know what it does. You put a high tech product up there or a piece of software, it doesn't always come through as far as the value proposition. So those things are not good for crowdfunding. And finally, if you're a pre-revenue company and you are just going to market and you need help with filling out the team or some other assistance, like a go-to-market strategy or whatever, look more closely at accelerators. They give substantial amounts of money now than they used to, and then they're dedicating time to help you finish out your business. And those are good options for early stage companies to look at as well. So that's a quick run through. We'll make these slides available to you if you're interested in them. So with that, let's go back to the questions to see what questions people may have.
Yeah, Hall, David had a question. For angels, he's wondering what the expectation is for revenue traction.
So for revenue traction, what they're looking for is what's called product validation and market validation. The product works and people will pay for it. And so they're looking for the fact that you sold it and maybe you sold it more than a few times and you're starting to build up sort of a repeatable, predictable process. When I look at it, 100, 200K of revenue is a really good number for angels because now you can start to see the business model in action. You can start to see happy customers. And so you're starting to get into it. When you talk to venture capital, you'll find that they often have a rule around 500K to $1 million. They're going to look for a lot more traction. They're going to look for a lot more substance behind the business because they're looking for the business to grow very rapidly thereafter. And so you really need to have a very substantial business put together. Angels, not quite so much. They just want to know you can sell it and you can make the product work. And a couple of 100K is what usually starts to signal that, yes, we're in the market and this is growing. They look very hard at the growth rate, year-over-year growth rates. In the venture world, they're looking for around at least a 50% annual growth rate year over year, especially in the early days. In fact, doubling is, from 100K to 200 to 400K is a really good number for the venture people to look at and say, yep, that's in the venture category. If you show up with a 25% annual growth rate, they're going to wonder, why is it growing so slow? Is the market not big? Do you not have the right product or what have you? So the growth rate becomes a key factor in some of these discussions as well.
All right, great. Great question, David. Thank you. Hall Jean is wondering if there are standard templates that early stage companies use that have proven successful in the solicitation of angels.
So when you say templates, if you're talking about pitch decks, what you'll find is that most pitch decks follow the same model. If you take an executive summary from a traditional business plan, where you describe the problem, the solution you offer, the product and what you're actually selling, the business model, is it recurring revenue, is it not, the team, who are the people, the competition, who are you up against, your competitive advantage, how are you better than others, a little bit about the financials, very high level thumbnail as far as growth rates and break evens and so forth. And then the investment amount. That's the traditional model used in all of these slides, is to go through and highlight each of those 10 topics. Some people do it in storyboard format. Other people do it in more business plan format, where a business plan, I just walk through and tell you each element of the business. Others start with a story and they tell you, I had this problem, I couldn't find a solution, I built my own, I had other people ask me for it, and then I turned it into a business. That's a very traditional model that you'll see out there. The story of the entrepreneur is the hero's journey is often used in these slides as well, where you built a business, you struggled through, you found the other side, and now you're growing very well. And investors like to see that because it shows you've wrung out the business and you have a lot of the features built into it for success going forward, which is usually a good team and a good product.
And just to follow on to that as well, does 10 Capital provide such templates?
Yes, we have standard templates for the pitch deck. If you need help with that, glad to share with you the template. The process for building a slide deck is as follows. When you sit down, what most people do is they go to the website and they start copying and pasting blocks of text and pictures off the website. What I recommend you do when you build a pitch deck is sit down and make a slide for each of the 10 topics we just talked about, problem, solution, product, etc. And on each slide, write 3 messages you want to say about that topic. On problem, what are the 3 things I want to say? Short bullet points. Don't write out big, long, wordy text. It's just to remind yourself what content you want to do and think through your story and what you want to say. Then go back and take those bullet points and start to massage them into meaningful data sets. Or, for example, you could put a graph in there, a chart, an image, or take that 15-word bullet point and turn it into a very succinct 5-word bullet point. And then go back and read through it to make sure that it flows from one step to the next. So start with what you want to say and then start to put the content onto it, and forget about copying and pasting off the web. You really don't need that. Maybe some pictures and charts, but the wording needs to come from you and needs to be a part of your message, not what you found on the website.
Great. Will is wondering where you recommend starting when trying to source high net worth individuals. Have you found cold calls or emails have worked in your experience?
Well, there's a group of people that manages funding for high, family offices and high net worth individuals, and they're called wealth advisors. And so you want to build a relationship with wealth advisors and explain what kind of deal you have and what you're looking for. And they know on their side who is looking to invest in startups and a little bit about their preference based on their background. So wealth advisors are a great place to start with this. There are family office clubs and others. that you charge pretty high fees to go out there, but you can network with people through those as well, where they have panels and they have education sessions and other things. So I would start with wealth advisors, because they're the ones that are managing the money or a portion of the family office's money, and they're always looking for new opportunities for their family offices.
Paul, I'm sorry, Ashley, if you have another question. Okay.
Please.
Does 10 Capital reach out to all of these 4 types of investors as part of the process? Okay.
Yeah, we have all of them in there. We've added pre-revenue or accelerators, because a lot of companies come in and, we think we're ready, but we're not. Investors come back and say, well, I'm not ready to invest because the team is incomplete, or the product is not filled out, or I don't see any revenue traction. And accelerators turn out to be a very good place for that, because there's people that can help you with that. And when you go to an accelerator, what I always say is make a list of what you need help with. What did investors tell you they have concerns with? And look for accelerators that can help you on those points. I'm not talking about the general accelerators where we're going to talk about sales 101. I'm talking about accelerators that can really help you build your business. And there are some venture studios out there that are very, very good at that. People that are experienced in a particular sector like fintech or health tech. If you're in one of those, there's some really good accelerators that people have put together that they are sector specific. And that's what you really need to start getting to, is not just general information, but sector specific information. We get a fair number of companies that are starting businesses in the fintech and healthcare space because it's a large market, they're growing fast and so forth. But if you don't know anybody in the industry, then it's hard to sell. If you don't know the regulatory, it's hard to build a product. And so there can be issues with that. So sometimes accelerators are a good fit in the early days, and they're giving you a decent chunk of money in some cases, $100,000, $150,000, which is not bad for starting off.
All right. Let's see. Any other questions? Again, feel free to turn on your video and your audio and ask them, or drop them in the chat box. Hall, if you want to just give a quick overview about what 10 Capital's Funding as a Service program is.
Sure. So my background is I started angel investing and ended up starting 3 angel networks. And what I witnessed is entrepreneurs coming into my room full of investors and pitching. 90% would pitch and go away, and we would never hear from them again. Have no idea what happened to them. They just disappeared on us. 10% though came back and gave us updates and reminders and told us more about it. And at heart, they were building a relationship and they were demonstrating the growth story. The key here is you have to demonstrate it. You can't just forecast it. Everybody forecasts it. Nobody cares about your forecast. What they want to know is, what are you doing to show traction in sales, team, product, and fundraise? Those are the core things you're responsible for. They're less interested in what's happening with the market or a competitor or what have you. And so what we're doing in Fundraising as a Service is helping you with that. We're making introductions, and then we're telling your growth story. Sales team, product, and fundraiser moving forward. And we're getting that back out in front of the investor so you get credit for that, and start setting up calls so you can start to build a relationship with them. Because the investor relations and the introductions is the hard part of the process. And we're doing that in Fundraising as a Service. We're not a broker. There's no back-end fees. It's pretty much that. If you need help with documents, we help with that. We help with putting together the pitch deck or refining it. And we also help with the data room, or what's called the due diligence box, which is the 10 or 12 documents that most investors expect to see in a diligence process. Entity filings, patent filings, articles of incorporation, income statement, balance sheet. There's a core set of documents you should have put together. So if somebody says, yes, I'm interested, I need to do diligence, you can provide in the box, and it shows that you have it put together and it's not going to be a paper chase. And so Fundraising as a Service is just really helping you be better at raising funding. We're not a broker. We're not raising funding for you, but we're helping you raise funding.
Great. David, another great question. Do you want to go ahead and ask that?
Sure. So do you have any specific recommendation for a post-seed round? So a Series A round that's different from your typical seed round pitches?
Sure. So the purpose of the seed round, what you're trying to demonstrate is that you can sell the product. And I've had people come out, and what you want to put in a seed is that I know I can sell this product. You know, I've done a little bit of it already. I can do more. I can sell the product. What you want to show in a Series A or the follow-on to the seed is that you can grow the company. No longer does investor care, can you sell it? They know you can sell it. Usually you have 500,000 or $1 million of revenue. We know you can sell it. What they want to know is, can you grow this business from 1 million to $10 million? And so now it's just from just selling the product to being able to actually increase the systems in the company to grow from $1 million up to 10. And so now it's hiring people, it's actually putting in processes in place to grow, it's actually scaling up the lead generation program. Those are the things that investors care about in the Series A or the second round, is ability to grow the business. So you want to talk a little bit more about growth systems as opposed to, can I sell it? And I see many seed companies go out for a next round with their same deck thinking, well, this worked great last time, and not do so well because it really didn't answer the question, because they're still answering the question, can you sell it? And we already know that. What we're trying to figure out is, if I gave you money, can you grow this $1 million company to a $10 million company? And it's more than just selling the product. It's all the other systems working together for it.
Good. All right. A little bit about our podcast series.
So we have a podcast program called Investor Connect. If you want to go to investorconnect.org, you can listen to any of 400 interviews we have with investors in some of our companies. And you can learn about investors, what they look for, what their advice is. It's a great educational tool. You have VCs, family office, angels, all different kinds of investors up there in all sectors: tech, healthcare, consumer product goods. And then if you're interested in learning more about just the world of startup funding, you know, all the things that go into it, we have what's called the Startup Funding Espresso. Is in the time it takes to drink an espresso in a day, you'll get to learn something about startup funding, how to due diligence, how to put together pitch decks. We cover all the different topics out there. We have hundreds of these espressos. If you sign up on the email, you'll get one in your inbox every day. Just hit the button and you can listen to it, or you can actually read it in about 60 seconds as well. So love to help you guys with anything related to startup funding. And those are two good educational tools that you can use as well.
Okay. And we do hold these Ask Me Anything series monthly. They're the first Tuesday of every month, at 11 a.m. Pacific time, 1 p.m. Central. You can see our full schedule of Ask Me Anything series at 10capital.group. If there are any more questions, now's the time. Let us know. I did just launch a poll, so if you guys want to go ahead and answer that for me, that would be great. And let's see. Don't think.
Actually, I did have another question, Hall.
Sure.
Given COVID this past year, I know that SaaS became a great business model. Would you say that there's more scrutiny on the SaaS companies than before, or are they better opportunities going forward?
Well, COVID gives us a whole new set of care abouts in many ways. Some things are morphing and changing into new applications or new areas. And so one of the questions investors will ask is your business COVID proof? Are you in a spot where if we go through another lockdown, will it hurt your business? Are you growing now that we're coming out of COVID and in various stages of reopening around the country? How well is your business doing? But having said that, it had the impact of creating a whole new set of care abouts. And so we're launching a whole new startup cycle coming out. The stock market is an all-time high right now. And so there's a lot of money looking for a place to go. And interest rates are zero, and it's not going into bonds or money markets anymore. It's going into public companies and startups is where it's going. So we see a lot of money coming out. So now's a great time to do it. And what you have to demonstrate is that post-COVID, you're COVID proof, you're in a good sector that's there. SaaS businesses overall did well, but if you were in the hospitality or the travel sector, you did see a dip, and you did see some pivoting going on to get into into the new sectors that are going to grow and away from the ones that were no longer going to grow. So you have to take into account market reality when you go forward. And investors were looking at this hard from Q2 onwards, and it's pretty clear what sectors are growing at this stage. Cool.
Thank you.
So we had some
All
other
right.
people join. Does anybody else want to turn the computer on and screen on and give us any other questions you have about your startup? And love to hear startup stories as well. So just let us know what you like to see there. And then you asked the question, are you sharing the slides in the recording? And the answer is yes. We'll share those with you guys afterwards. So if you like to capture those slides, you can go back and match your deal to one of those out there. I'd say the vast majority of companies that come are really good fits for family office, angels, and accelerators. Some are good for crowdfunding. We recommend that where necessary. Crowdfunding used to be a thing that you only did if you were trying to get money to build a product, but now it's with Title III crowdfunding, you can raise up to $5 million, and you can get easily 300-400K with the right group and the right portal. We're happy to tell you more about those. So it's becoming a viable way. Again, it needs to be consumer facing. It can't be some esoteric piece of software, because that won't translate well into the crowdfunding world itself.
All right. Well, it looks like, oh, we did have one other question. Hall, what are your thoughts on platforms like Seed Invest or Republic?
Well, those are good examples. Republic is a Title III crowdfunding platform. The top three out there for Title III is Start Engine, Republic, and WeFunder. And those guys started 4 or 5 years ago. And so they were there in the early days. I remember looking at their deals way back when, and we were all doing about the same thing at that time. We actually did crowdfunding for several years with an interstate license from about 2014 to 2016, and found it did very well for consumer-facing products. We hung up the portal because we wanted to go back to accredited investors, because we had a lot of tech and healthcare deals that were not doing well on the crowdfunding sites. Seed Invest is actually a broker dealer that transacts online, and so it's also a good portal. It's a little expensive as far as the fees go, so you have to always ask about the fees. There is compliance with all of those. When you go in, you will spend 4 to 6 weeks going through compliance, which is getting in Title III, they require you to get a financial audit on your financial statements. And then in a broker situation, they're doing pretty much the same thing. They're doing compliance exercise on it. And then when you run a campaign, you're running a 90-day campaign, not a day longer. So you have to get very much ready for it. And when you when the firing gun goes off, you start raising as fast as you can, because you have only 90 days. So, and after that, it just starts to get stale and hard to get interest. So you have to plan the campaign out very carefully. But those are good portals to look at. Again, Start Engine and WeFunder are the other ones I'd put on that list to go and check out, how much support they offer you and what they provide and so forth. There's actually 47 Title III crowdfunding platforms out there. So there's others that are becoming niche. And so you might check out some of the others if you have a particular niche you think you might want to go after and would like something more specific for your platform, your play.
We are just about at the 30-minute mark. So for those of you that do have to hop off for something else, we do appreciate you being here. We will stay on here for a bit longer if anybody has any other specific questions about their own business and fundraise. So again, feel free to turn on camera and audio, and we're happy to get those questions answered. Don't everybody talk at once.
So this is Gene Thomas. I'm on audio only. Can you hear me okay?
Yeah, hi, Gene.
Hi, thank you. On the Title III crowdfunding, can you comment on how does an angel investor or other investor feel about a company that has either done a crowdfunding or is doing one in concert with soliciting them as a potential investor?
Early on, I think angels look warily at crowdfunding because they thought it was going to be, not very smart money and so forth. But over the years, people have gotten wiser about, making these investments. And as an angel investor, I look at someone doing crowdfunding as a positive because number one, for two reasons. One is if you do a crowdfunding campaign, whether it be Kickstarter or Title III or otherwise, you learn the campaign process. I can tell somebody who's been through one of those because their documents look great and it covers all the points and they've really put it through the ringer, so to speak. So learning the campaign process really benefits them for raising money from angels and other investors later in life. So it's a plus on that side. Two is you get a lot of market validation going on because you don't go through those campaigns without getting a lot of feedback about your product, your model, your service, and what you're doing. And it's always good information to tune the model up because it's been refined because you've had a lot of people look at it and test it and give you feedback on it. So I see there's a lot of market and product validation that comes out of that process. That's a positive benefit for most businesses as well. So I think it's considered a good stepping stone to come up and get your business ready. So I think people look at that as really good. There is some concern about some of the crowdfunding, what is the valuation is offered to the investor. Some of these valuations are not yet sophisticated investor tested yet. And so you can see a wide range of things out there. So as an angel investor, you start looking hard at the valuation and the terms of the deal itself, because most crowdfunders are not looking at that aspect. They're just looking at the product. And if you're putting in $500 or $1,000, nobody, they're not spending a lot of detailed work on it. So the drawback to crowdfunding is that you can get some terms that range widely up and down the valuation curve on them as well.
Thank you. I appreciate that. If I can do a follow-on.
Sure.
If you do a crowdfunding campaign, what human resource do you have to have available? I'm thinking somebody daily has to be monitoring the crowdfunding electronic community. Can you educate us on the level of effort that's required to manage that?
So yeah, same with Kickstarter and any crowdfunding campaign. Every day you're getting a set of emails coming in with people that are asking about the product or the raise or the terms or some aspect of it, and you have to answer those. So it's no different than just answering an email inbox that you're answering now. I would dedicate at least a half hour to an hour a day to answer those questions because you want to stay up on it and be timely with it. If we don't answer today, but wait a week, they'll be gone. They won't be back because they're off to something else. So you have to be very timely with that. And again, great feedback comes out of it. When anything comes in, you want to capture that in for product development or business model or something in the future as well.
Got it. Thank you very much. Appreciate that.
Sure. You can also buy marketing services. There's a fair number of groups out there that will do social media marketing for you. There's a rule in the crowdfunding world I'm starting to hear about. I don't think it's true for everybody, is that you can spend anywhere from 10 to 20% of your fundraise on marketing. Social media marketing is very popular with this, especially with Title III, where anybody can invest. Well, they can blast this to the world, and I see people get $300,000-$400,000 out of these crowdfunding campaigns using those marketing services, and so you can get quite a bit of support when you're dealing with angels and so forth. We're in there helping with funding as a service. But it's a little bit different game. You have to go build a relationship. You have to go meet with them because they're writing $50,000 checks, not $500 checks. So the dynamics is quite a bit different in that case. Cool. Anybody else have any questions?
Yeah.
Yes, Aurelio.
Hear me?
Yes, go ahead.
Great. So I hear a lot about the sort of idea of product and the four main, the sales teams, product and fundraising. What about services?
So product and services are two sides of the same coin. A product is a physical device, and a service is something you're doing for people. And so again, that's something that investors would look for, and because that's what you control. I get a lot of startups coming in and they want to talk about the market and how big it is, or how a competitor fell down, or how there's an opening in the marketplace. But none of that tells me what the startup's execution is and how they're making their way towards it, because it's all about traction. It's all about progress and investors are trying to see how fast you make your way through those steps, how many you have already made your way through. And many startups will try to distract away by talking about their forecast. It's interesting, but that's not telling me what you're doing. And with the angels and VCs, you have to demonstrate the growth story. And the vast majority of people come in and they're forecasting the growth story. It's going to be great, but you have to do more than just forecast it. You have to come in and start showing that it's actually happening. We are actually getting traction. We're actually closing it. We're meeting milestones that we came up with. So that's why I've focused on those core four. Intellectual property is another one. You control that. Usually it's more of a one and done. It's not a long-term thing, but products and services are pretty much two sides of the same coin, which is what you're selling. And can you deliver that?
Got it. Thank you.
Cool. Thanks.
All right, gentlemen. Well, I think if that's the end of the questions. This was a great session. Thank you all so much for joining. Again, we will get this recording out to y'all if you would like to review the content. And please check out 10capital.group for the full list of our monthly AMAs. Again, I'm Ashley Mataisi. You have been talking with our CEO, Hall Martin, and we hope everybody has a great day.
Thanks, guys.
Thanks.